Welcome back to the deep dive. Today we're digging into a company that's, well, pretty much become the nerve center for modern digital operations. I'm talking about Datadog, ticker DDOG. You look at it today, everyone's moving to multiple clouds using microservices, containers. It's incredibly complex, right? Datadog basically sells the solution to manage that chaos. But here's the thing, the puzzle we need to solve. The stock trades at this eye-watering valuation. It's priced like it can do no wrong, ever. So our mission today is figuring out why. What makes the business so good that the market gives it that kind of premium?
That's exactly it. What are the deep structural advantages here? Because fundamentally, Datadog is a B2B SaaS platform. They offer companies what often called a single pane of glass, one place to see everything. It's like an insurance policy for your whole tech stack, infrastructure, app security, logs. And yeah, the big question is, are those advantages strong enough, durable enough to justify that valuation hurdle?
Okay, let's start with the basics. How do they actually make money? What's the core revenue model here that's driving this incredible growth? Is it just, better software sales?
It's really the classic land and expand model, but like perfected, the land part. Super low friction. A customer, often just one dev team, maybe signs up for one product out of their 20-plus offerings. Infrastructure monitoring is a common starting point. Often it's self-service, super easy to get started.
Right, get a foot in the door.
Exactly. But the expand part is where the magic happens.
Yeah.
It works along two main lines, two vectors driving growth almost automatically. First, there's usage-based growth. Their pricing is tied directly to how much the customer uses, number of servers, amount of data, things like that. So as the customer's own business scales up, as their digital footprint naturally expands, Datadog's revenue just grows right along with it, often without any extra sales effort.
Okay, so customers pay more as they get bigger and use more resources. Kind of like a tax on their own success and complexity. What's the second expansion vector?
The second one is product-based growth. Once a customer is using the platform, say for infrastructure, their engineers get used to it, the dashboards, the alerts. Then adopting another Datadog module, maybe application performance monitoring, APM, or one of their newer security tools, it becomes almost a no-brainer internally. The convenience for the engineers already using the platform is a huge selling point, so they add more products, expanding revenue from that existing customer base, again, with pretty minimal sales friction.
That explains the rapid growth we're seeing now. But you mentioned endurance. Why is this model likely to last, say, 10 or 20 years? Why isn't it just the hot tool for this era of tech?
Good question. The endurance, I think, comes from three really big structural tailwinds. These aren't just trends. They're fundamental shifts in technology. First, the move to the cloud. That multi-decade migration. Still happening. More workloads moving means more potential customers, more usage. Second, the irreversible rise in complexity. I mean, think about modern software architectures. Microservices, containers, serverless. It's just inherently more distributed, more chaotic than old monolithic apps.
Yeah.
Datadog thrives on managing that chaos.
Okay, cloud and complexity. What's the third?
The third, and this might be the most important one, is the data explosion. These complex systems, they generate absolutely massive amounts of telemetry, data logs, metrics, traces, just a fire hose of data. And Datadog's usage-based model, it's perfectly designed to capture value from that data surge. Plus, think about AI, large language model.
Right, more complex systems, more black boxes.
Exactly. More stuff that absolutely needs monitoring. It just keeps expanding the need for what they do.
So if I pull back, Datadog isn't just selling software features. They've effectively built a toll road on the highway of increasing digital complexity. The messier tech gets, the more valuable their service becomes.
That's a great way to put it. It's a pull from the market's needs, driven by the fundamental direction of technology, not just a push from their sales team.
Okay, powerful model. But if it's so essential, what stops competitors? What's the actual economic moat here, especially when you've got giants like AWS or Azure who could potentially offer similar tools, maybe cheaper, maybe even free?
Yeah, the competition question is key. The primary moat, I'd argue, is extremely high switching costs. And it's not just sticky like some software, it's technically embedded. Think about it. Datadog agents run deep within a customer's infrastructure. It's integrated with, hundreds of different technologies they might be using. It's woven into their operations.
Well, hold on. You hear the complaints all the time, right? Datadog is expensive. People talk about the sticker shock. If price is the main pain point, doesn't that make it easier for customers to look elsewhere?
It seems like it should, but it's kind of paradoxical. That high price, and the fact customers still pay it, is almost evidence of the moat's strength. You have to look beyond the subscription cost to the rip-out cost.
The rip-out cost.
Yeah, the financial cost, the annual bill, that's one thing. But the cost of actually migrating off Datadog, that's where the real pain lies. It's operational, it's cognitive, it's massive. Think about what happens inside the platform. Engineers don't just install it, they build on top of it. They create maybe hundreds of custom dashboards, thousands of specific alert rules tuned to their environment, workflows for troubleshooting.
Their operational brain, like you said earlier.
Precisely. So if a big company decides to switch, first, you probably have to freeze all new feature development for months while engineering resources are diverted. Then you have to retrain literally every engineer, every operations person on the new tool. And you have to accept that during the transition, which could take 6 months, a year, you're guaranteed to have critical blind spots. Things will break, alerts will be missed.
Wow. So rewriting thousands of configurations, retraining dozens of teams, the internal cost just explodes.
It explodes. The visible bill is high, yes. But the invisible cost of leaving is orders of magnitude higher for any established customer. So they complain, maybe they optimize usage a bit, but fundamentally they stay.
That makes sense qualitatively. What about the numbers? Is there quantitative proof this moat is actually getting wider?
Absolutely. 2 key metrics really show this. First, look at multi-product adoption. The percentage of customers using more and more Datadog products just keeps climbing. I think the latest numbers were something like 43% use 4 or more products and nearly 20% use 6 or more. Each extra product they adopt makes the platform stickier. It integrates another team, another data source, another workflow. It's like adding another steel bar to the cage.
Okay, more products equals stickier customers. What's the second metric?
The second is the dollar-based net retention rate, or DBNRR. This tells you how much more your existing customers are spending this year compared to last year. Datadog's DBNRR has consistently been, well over 100%, often in the 110%, 120% range. That means the average existing customer isn't just staying, they're spending significantly more each year. That's driven by both that usage growth we talked about and adopting more products.
So you've got the easy landing, the automatic expansion from usage, the cross-selling of more products, the incredibly high switching costs, all happening against these massive secular tailwinds of cloud and complexity. It feels like these forces aren't just adding up, they're multiplying each other.
Exactly. That's the perfect way to think about it. It reminds me of Charlie Munger's concept, the Lollapalooza effect.
Right, where multiple factors combine to create a result far greater than the sum of the parts.
Precisely. It's not 2 + 2 = 4. It's like 2 times 2 times 2. The high switching costs reinforce the brand reputation among developers, which helps them attract top engineering talent, which fuels more R&D, which creates even better, stickier products, which locks customers in further, and the whole thing gets amplified by the underlying growth in cloud complexity. It's a powerful, self-reinforcing flywheel.
Okay, but let's circle back to the biggest perceived threat, the hyperscalers. AWS, Azure, Google Cloud, they have the resources, they have the customer relationship. What stops AWS from just bundling a good enough CloudWatch observability suite for free and crushing Datadog's pricing power?
That's the billion-dollar question, isn't it? But Datadog has a key durable advantage here. It's multi-cloud Switzerland status. Think strategically. Why are large enterprises adopting multi-cloud or hybrid cloud strategies in the first place? Often, it's specifically to avoid getting locked into a single vendor like AWS.
Right, for negotiation leverage resilience.
Exactly. So if AWS offers a great monitoring tool, but it only works well within AWS, using it actually increases your lock-in. That runs counter to the enterprise's strategy. Datadog, on the other hand, is the neutral third party. It works consistently across AWS, Azure, GCP, even your own on-premise data centers. It gives you that single view regardless of where your workloads run.
So the hyperscalers can't easily replicate that neutral position without undermining their own core cloud platform strategy.
It's very difficult.
Yeah.
Ethically, strategically. It's a huge conflict of interest for them to be the truly unbiased observability layer across competing clouds.
Yeah.
That neutrality is a powerful structural advantage for Datadog.
Okay, let's shift gears to the people running the show and the financials. Founder-led company, right? Is the leadership aligned with long-term shareholders? Especially thinking about how they allocate capital with all this growth.
Yeah, the alignment here is, frankly, best in class. It's still founder-led. Olivier Pommel is CEO, Alexis Lacroix is CTO. They're technical founders. They built this thing. And crucially, they have massive personal stakes. Pommel owns something like 4% of the company. Their personal net worth is overwhelmingly tied up in Datadog stock. That's about as strong an alignment, that skin in the game, as you can get.
And how are they deploying the cash the business generates?
It's very simple, very rational. Almost all the cash generated gets plowed right back into the business,
Really?
primarily into massive R&D spending. R&D expenses just climbed and climbed. I think it hit something like 45% of revenue in 2023. That's the fuel for the Lollapalooza flywheel we talked about constantly, building new products, enhancing existing ones, making the platform stickier.
45% R&D. Okay, that leads directly to this apparent contradiction in the financials. You're describing this amazing cash-gushing business, but if I pull up a stock screener, I often see low, maybe even negative accounting profits. Reported return on invested capital, ROIC, looks terrible. How do those two realities coexist?
Right, this is super important. It's what you might call the ROIC illusion. Yeah. And you need that map versus territory mental model to understand it. The accounting map, generally accepted accounting principles, GAAP forces companies to treat R&D spending as an immediate operating expense. That huge 45% of revenue, it gets subtracted from revenue right now, crushing reported net income, and therefore crushing the calculated ROIC based on that net income.
So the map looks bad.
The map looks bad according to traditional metrics. But the economic territory, the actual underlying reality of the business, that's very different. Look at the free cash flow, FCF. Datadog generates fantastic FCF margins, close to 30% recently. And that FCF is growing explosively year after year. That massive R&D spend isn't really an expense in the economic sense. It's functionally a growth capital expenditure. They're investing heavily today to build new products, new features, essentially new revenue-generating assets that will pay off for years to come.
Ah, so the accounting rules obscure the fact that they're reinvesting heavily for future growth, but the strong free cash flow proves the underlying economics are actually extremely healthy.
Exactly. The FCF generation is the proof that the economic return on those R&D investments is very, very high, even if GAAP accounting makes it look poor on the surface. Plus, look at their balance sheets.
Strong.
Fortress. They're sitting on, what, over $4 billion in cash and equivalents versus less than $1 billion in debt. Essentially zero leverage risk. It's a financial fortress backing the operational fortress.
Okay, we've painted a picture of a really high-quality business. Wonderful, even. Which brings us back to the elephant in the room, the price, the valuation. With multiples often in the stratosphere, what's the main risk an investor faces today?
The number one risk, without a doubt, is valuation risk. It's not really business risk, the risk that the company itself will stumble or fail. It seems structurally sound. The risk is simply that the current stock price already reflects all the good news, all the expected hypergrowth for, say, the next 5, maybe even 10 years. It's priced for perfection.
So any slip-up, any slight deceleration could cause a major correction in the stock price, even if the underlying business remains strong.
Precisely. If you're an investor waiting for Datadog to look cheap on a standard PE ratio or EV sales multiple, you'll probably be waiting forever. You'll miss it entirely. The margin of safety here can't really be quantitative based on the current price. It has to be qualitative. It's your confidence level and the durability of that moat, the length of the reinvestment runway, and the quality of the founder-led management.
Let's really stress test that moat then. Forget valuation for a second. If we invert the bull case, what are the top, say, 3 permanent risks that could actually break this business model, impair the flywheel long term?
Okay, 3 big ones to watch. First, back to the hyperscaler bundling risk. We talked about why Datadog has an advantage now. But what if AWS or Google gets really aggressive? What if they decide to offer a truly good enough suite of observability tools, deeply integrated and bundled for free or near free with their core cloud services? That could potentially commoditize the basic monitoring layer and put a hard cap on Datadog's pricing power, especially for smaller customers.
Okay, hyperscaler aggression. What's number 2?
Number 2 is a risk inherent in their own model. Customer cost fatigue, or maybe call it revolt risk. Because those usage-based bills can get so high and they're very visible on the CFO's dashboard, it creates a powerful incentive for customers to fight back. They create internal teams specifically focused on optimizing their Datadog spend, trying to send less data, finding workarounds, maybe shifting some workloads to cheaper open-source alternatives.
So the model's strength charging for usage becomes a vulnerability if customers aggressively push back on that usage.
Exactly. If that optimization effort becomes widespread and really successful, it could lead to a permanent slowdown in that crucial DBNRR metric. It's the flip side of their success.
Makes sense. And the third major risk?
The third one is the big unknown, genuine technological disruption. The entire Datadog value proposition is built on managing complexity. The more complex cloud environments become, the better for them. But what if? What if a new technology paradigm emerges that fundamentally simplifies things? Maybe AI-driven systems that are largely self-managing, self-healing, or some new architectural layer that abstracts away 80% of the current operational chaos.
If complexity drastically
And
decreases.
the core need for Datadog's control tower potentially erodes significantly. That's probably a lower probability risk in the near term, but it's the kind of fundamental shift that could truly impair the long-term story.
All right, those are some serious risks to consider. On the flip side, what are the potential catalysts or accelerators that could drive growth even faster, maybe even help justify that premium valuation?
I see two major ones right now that could significantly expand their market opportunity. First is AI observability. As companies deploy more sophisticated AI models, particularly things like large language models, these systems become critical new black boxes within their infrastructure. They absolutely have to be monitored for performance, cost, security, bias. This is creating a whole new multi-billion-dollar category of observability need, and Datadog is well positioned to capture a big chunk of it,
So AI complexity is actually another tailwind for them.
potentially a huge one. The second big accelerator is their push into DevSecOps consolidation. Datadog isn't just about infrastructure and apps anymore. They're making a very aggressive move into the security market. Think cloud SIEM, security information and event management, application security monitoring. By integrating security data and workflows directly onto the same platform developers and operations teams are already using, they can potentially displace several existing, expensive, standalone security tools.
And consolidate budget from the CIs onto their platform.
Exactly. That allows them to significantly increase the total annual recurring revenue, the ARR, they can get from each customer by tapping into those large, high-priority security budgets.
Okay, so AI and security are major growth vectors. If you were to synthesize this with some second-level thinking, what's the market potentially still missing about Datadog?
I think the surface-level view, the consensus, sees Datadog as a successful bundle. They bundled infrastructure monitoring plus APM plus log management plus security, and the bundle is convenient. But the deeper insight, I believe, is that the value isn't just additive, it's nonlinear, it's multiplicative. The real magic comes from the Synaptic integration between these modules. It's infrastructure times APM times logs times security. The ability for an engineer to instantly pivot between a performance issue in an application to the underlying infrastructure metric to the relevant security log, all on one screen, without switching tools. That seamless workflow creates a value far greater than just having those tools separately.
The whole is much greater than the sum of its parts because of that deep integration.
Precisely. And I think the market might still be underappreciating the power of that nonlinear effect and how it compounds those switching costs even further over time.
Okay, let's try to sum this up. We've got what looks like a very high-quality business, essentially a toll road built on these irreversible trends of cloud adoption and rising complexity. It's protected by a widening moat built on extremely high switching costs, amplified by multi-product adoption and that nonlinear Lollapalooza effect. It's run by highly aligned founders who are reinvesting heavily, evidenced not by accounting profits, but by fortress-like financials and elite free cash flow generation.
That's a fair summary. It ticks most of the boxes for a truly wonderful business. But, and it's a big but, the ultimate determinant of your return as an investor is the price you pay. The challenge here is that Datadog needs to do more than just succeed. It needs to execute flawlessly, probably exceed already high expectations, consistently for many years to come, just to justify the valuation the market is already giving it today.
Yeah.
That's the core tension.
It really is. And that leaves us with a final provocative thought for you, the listener, to ponder. If we accept that Datadog's massive R&D spend, that 45% of revenue is truly an investment in future growth, a growth Capex, rather than just an operating expense, what might its actual economic return on invested capital look like? And drilling deeper, how much of Datadog's current market valuation could arguably be attributed not to its existing products, but purely to the market's expectation of future innovations and products that haven't even been launched yet, essentially, the capitalized value of that powerful R&D engine itself? Something to think about. Thanks for diving deep with us today.